This reading is about free cash flow valuation. Here we'll talk about the free cash flow to firm and free cash flow to equity valuation approaches. Here we need to understand the difference between free cash flow to firm and free cash flow to equity. Very briefly, free cash flow to firm is the cash flow that is available to all providers of capital. So that includes debt holders and equity holders. So the cash flow that is available to all providers of equity after covering operating expenses and taxes. Whereas free cash flow to equity is the cash flow that is available to equity providers. So stockholders will have access to free cash flow to equity. Then we'll talk about how we forecast free cash flows. The next segment is about free cash flow model variations. So in the context of free cash flow valuation, we have different variations or different types of sub-models. We'll talk about them. And the last part of this reading is about non-operating assets and firm value. So how is firm value impacted by non-operating assets? In terms of discounted cash flow methods, we have already talked about the dividend discount model, where an analyst looks at future dividends and discounts back. What we are talking about here is also a method based on discounting future cash flows, but the cash flows here are different. So in the DDM, the cash flow is the dividend. Here the cash flow is either free cash flow to firm or free cash flow to equity. And most analysts actually prefer these definitions of cash flow over dividends. And there are several reasons for this. In fact, here are the bullet points taken straight from the introduction, which describe the circumstances in which most analysts would use FCFF or FCFE over the DDM. Many companies do not pay dividends. Then obviously it becomes difficult to use the dividend discount model. There are companies which pay dividends, but the dividends paid are significantly different from the company's capacity to pay dividends. What that means is you might have a company like Microsoft, which has a substantial free cash flow to equity, but the dividend number is very small. So it doesn't make sense to use dividends to value Microsoft. Another company might actually, at least in the short term, be paying dividends higher than might be indicated by the free cash flow. So in circumstances where the dividends and the free cash flow don't align, it makes more sense to use a free cash flow measure to value a firm. And finally, this is an important point. If you are buying a company and you are taking an ownership stake, so a large stake, such that you will then control the company, you can change the dividends. And in fact, you can have an impact on cash flows and a direct impact on the dividends. You might decide to pay higher dividends, you might decide to cut dividends and invest more money. So when you are taking a control perspective where the future dividend outlook is not well defined, it makes a lot more sense to use a free cash flow based valuation method. FCFF and FCFE valuation approaches. First, we'll define free cash flows. And this journey of defining free cash flow started at level 1, where you might or might not have understood the different definitions. And even without understanding those definitions, you can clear level 1, but that cannot happen with level 2. Here you need to have a proper understanding of the different kinds of cash flows. Then we'll talk about the present value of free cash flows. And finally, we'll talk about the single stage FCFF and FCFE models. So here is a basic picture that you might recall from level 1. Companies generate money, they generate cash. Who has a claim on this money that is being generated? It is the providers of capital, the lenders and the shareholders. Obviously, the lenders get the first claim, and then once the lenders are paid off, then what remains goes to the equity holders or the shareholders. Free cash flow to firm is this entire money that is available to all suppliers of capital. And this is the money available after taxes are paid. So that is free cash flow to firm. Simplistically here you can think of the firm as the lenders and the shareholders. Then free cash flow to equity is the cash flow available to the company's common equity holders after all operating expenses, interest and principal payments have been paid and necessary investments in working capital and fixed capital have been made. So as the term implies, this is the money available only to equity holders once the other commitments have been covered. So we have briefly defined FCFF and FCFE. Under what circumstances would you prefer using an FCFF model over an FCFE model? There are two broad circumstances. The first is where you have a levered company or a leveraged company and the FCFE is negative, at least in the short run. Why might this happen? If the leverage is high, then obviously the interest cost will be fairly high. So it is possible that at least in the short run, equity holders are paying off the debt holders and in essence, the FCFE is negative. So there it would make sense to use the FCFF model to come up with the total value of the firm. And then once you come up with the total value of the firm, then you can subtract the market value of debt to come up with the value of equity. Now I am just glossing over this point in the middle because we'll cover this in section 5, but simplistically in sections 1 through 4 we are assuming that the firm value is approximately equal to the value of the operating assets. And this happens if this extra cash and marketable securities is approximately zero, or if this is very little compared to the value of the operating assets, then this holds true. Now, in case you are slightly puzzled by this, just hold your thought. In section 5, I'll cover this in detail. The simplistic point is that you use FCFF to come up with the overall value of the firm. You subtract the market value of debt, and then you get the value of equity. Now, another situation where you would use FCFF rather than FCFE is where the capital structure is changing frequently. So if the capital structure has changed frequently in the past, you might not have a good sense for the growth rate of FCFE, and you might not be able to predict FCFE in the future. If the capital structure has been changing, then it is more likely that the FCFF, the free cash flow to firm, is relatively more stable compared to FCFE. Also, as you will see later, when you value a firm using these two methods, if you are using free cash flow to firm, then you discount using the weighted average cost of capital. And when you value using FCFE, you discount using the cost of equity. If the capital structure has been changing a lot, then the cost of equity is likely to be more volatile than the weighted average cost of capital. So the key takeaway here is that if the capital structure has been changing a lot, then it makes more sense to use free cash flow to firm as your measure of cash flow. Okay, now this should look extremely familiar. The present value of free cash flow, I've already alluded to this. If you are using your free cash flows to firm, then you come up with the firm value by projecting all your free cash flows out to infinity and discounting back using the cost of capital. What is the justification for discounting at the weighted average cost of capital? The answer is fairly straightforward. Since you are looking at the cash available to all providers of capital, you should also then discount at the rate associated with capital from all sources. So that is the weighted average cost of capital. And once you compute the value of the firm, then you can compute equity value by taking the firm value and subtracting the market value of debt. If you are using free cash flow to equity, so now let's say your measure of cash flow is FCFE, then this number or the free cash flow to equity numbers need to be discounted at the cost of equity, and that will directly give you the value of equity for the firm. If I give you a simple scenario where the free cash flow to equity is 100 million, so let's say this is times 0, and for the upcoming year you expect the free cash flow to equity to be 100 million, and you expect this to grow at a constant rate of 5%, and let's say that the cost of equity is 10%, then what is the value of equity at time 0? The value of equity can be computed using the Gordon growth model. So you would take the FCFE at the end of period 1, which is 100 million in this case, divided by R minus G. So as long as you can make this assumption that FCFE is growing at a constant rate, at a sustainable rate of 5%, then you use the Gordon growth model to come up with the value at time 0. Okay, here is a very simple example just to get you started. I want you to do this before you look at the solutions. So this is fairly straightforward. We compute the WACC the way we have done in the past. Then the value of the firm is the free cash flow at the end of period 1 divided by WACC minus G. You come up with the value. Then the value of equity is the firm value minus the market value of debt. So this represents the equity value, and then you divide by the number of shares outstanding to come up with an estimate of the value per share. The essence of this section is to learn different ways of computing FCFF and FCFE, and then using whatever data is given to you to come up with an appropriate measure of cash flow. So let's start with the most basic formula, which is if you are given the net income, how do you come up with the free cash flow to firm? And you saw this first at level 1 in the reading on cash flows. And I hope you learnt it back then, but here you absolutely must know this relationship. The free cash flow to firm, remember, is the money available to all providers of capital. So if you start with net income, which is an indication of the earnings or money available to shareholders only, we need to make, broadly speaking, two sorts of adjustments. One adjustment has to do with non-cash charges. Another adjustment has to do with the fact that we are now going to calculate money available to all shareholders. That includes debt holders, and actually there is a third which has to do with fixed capital and working capital, so I'll just explain that in a moment. But anyway, you start with net income, you add non-cash charges such as depreciation because we are coming up with a cash flow measure. You add interest, so interest into 1 minus T, after tax interest. Why are you doing this? Because you computed net income after subtracting interest, and you actually want a number that covers all providers of capital, which includes the bondholders. So you add back the after-tax interest expense. Then, since net income does not include the investment in fixed capital, you want to subtract that investment in fixed capital, and you also want to subtract the investment in working capital. If money has been spent to build up inventory and that inventory has not been sold, money has been spent, but that cost is not reflected in the net income. So if you are coming up with a cash number, you have to subtract the increase in net working capital. Now there is an important philosophical point here also, which is that when you are coming up with FCFF, you are subtracting the fixed capital investment and the working capital investment. The logic is that you want a free cash flow measure such that the company is not being impaired in any way. And for a company to keep doing well, the investment in fixed capital needs to be made. So that is an important cash expense which is being reflected in the FCFF measure. So regardless of whether you understand the finer points underlying this measure, you need to know this formula extremely well. In fact, I can almost guarantee that there will be at least a few questions on the exam where you need to use this relationship. All right, so speaking of using that relationship, we will start doing so. Let's look at example 2, where you will need to start with net income and compute the FCFF. So quickly read through this. Okay, so what we'll need to do is start with net income. Let's just work with 2008 initially. And the first thing you need to be able to do is regurgitate the formula that I just shared with you. So let's do that. The free cash flow to firm is equal to the net income plus non-cash charges, and then you subtract the fixed capital investment and you subtract the working capital investment. In this relatively simplistic example, we have the net income for 2008, so that number is given, plus non-cash charges, that's the depreciation, and I actually forgot something. I need to also add back the interest into 1 minus t. Is that given? So on this particular slide, we have the net income, we have the non-cash charges, we have the interest expense at 7%, so that interest expense is given, and somewhere we are also given the tax rate, so we will actually use the after tax, so interest of this into 1 minus 30%. What's not given on these slides is these two numbers, fixed capital investment and working capital investment. So let's go to the next slide. If you look at 2008 and you look at fixed assets, the fixed assets stayed at 500. So at least for 2008, remember these are end of year numbers. So we are saying that in 2008, the fixed capital investment was 0. What about the working capital investment? What you do is you figure out the net working capital at the end of 2007, not including cash, because we are looking at changes in cash. So you do not use cash. What's the net working capital at the end of 2007? It would be 60, which is inventory, and then accounts payable, which is the only working capital related liability. So that's 0. And then what do we have at the end of 2008? 66 and 50. So basically we have at the end of 2008, we have 66 plus 50. At the start we had this much. So the increase in working capital is the sum of these two minus 60, which is 56. Okay, so here again I missed something. We need to actually also add the accounts receivable, because that's also working capital. So your working capital is 100 plus 66 minus 50. That's the working capital at the end of 2008. And from that you take away the working capital at the end of 2007, and that will give you your change in working capital. So if you actually look at the numbers, then the calculation for working capital is fairly straightforward, and it's shown over here. If you take 2008, at the end of 2008, the net working capital is 166 minus 50, which is 116. At the start of the year, start of 2008, which is end of 2007, working capital is 60. So the change in working capital is 56. Now, on this slide, I've actually put together all the relevant numbers. So this is the formula. Net income you pick up from here, 97.52. The non-cash charge in 2008 is the depreciation, which is you add 45. The interest expense is 15.68 into 1 minus 0.3. 30% is the tax rate. And then you subtract the fixed capital investment, which is 0 because you are staying at 500, so minus 0, and minus the working capital investment, which we actually calculated on the previous slide, but it can also be calculated based on the information shown over here. using these three elements, that's minus 56. So when you do the calculation, you should get 97.50. And I'm not going to go over the calculations for 2009 and 2010, but the logic is the same. The difference is in the numbers, obviously. So in 2009, there was an investment in working capital, so that's why you have minus 50 over here. Make sure you can go through these numbers because this is extremely important. Next point now has to do with calculating FCFF from the statement of cash flows. In section 3.1, we said we are starting with net income. Now we are starting with cash flow from operations. Before coming up with the formula, we need to understand what is included and what is not included in CFO. And this hopefully is another flashback, because this particular table was also there at level 1 in the reading on cash flows, where we looked at the treatment of different items such as interest received, interest paid under IFRS and US GAAP. If you take interest expense or interest paid, under US GAAP, that shows up as an operating cash flow. In IFRS, the interest paid could either be operating or financing. This particular reading largely takes a US GAAP perspective, but you obviously need to understand both the treatment under IFRS and US GAAP. For starters, let's take US GAAP. In the case of US GAAP, the free cash flow to firm can be estimated as follows. You start with the CFO and then you add the interest expense, the after-tax interest expense. Why are we doing this? Again, FCFF is the money available to all suppliers of capital. If in your CFO you have already subtracted the interest expense, then you need to add it back. That's what we are doing here on an after-tax basis. Then we need to subtract the investment in fixed capital, which again is consistent with what we've talked about earlier. But unlike the previous discussion with net income, where we subtracted the increase in working capital, we are not doing so over here. Why? The reason is that in coming up with your CFO, you have already accounted for changes in working capital, therefore you don't need to show it over here. So this is the second major formula that you are learning, which is if you are already given CFO and you are using US GAAP, where you know that the interest expense is part of the CFO, then this is how you come up with FCFF, starting with cash flow from operations. Now, what if you were using IFRS? Then you would have to check whether the interest paid or the interest expense is being shown as an operating cash flow or a financing cash flow. If the interest expense is being shown as an operating cash flow, would the formula change or would it be the same? It would obviously be the same if it is operating. This is US GAAP, right, where interest is shown as operating. What if the interest is treated as a financing expense? How does this formula change? Then we would not need to add back because the interest expense is not part of CFO. Okay, so every concept that we'll talk about will be followed by a related example. So this is example 3. Let's, for 2008, calculate the free cash flow. And your starting point is the CFO. So this is fairly straightforward. Your starting point is 86.52. And then you add the interest expense into 1 minus T. The interest expense is also shown over here. It is 15.68. So you'll have 15.68 into 1 minus the tax rate, which is again 30%. And then investment in fixed capital, which for 2008 is 0. So you do the calculation and that's shown over here. Okay, interest expense into 1 minus T will give you this number. Very straightforward calculation. Make sure you know this well. Okay. Dealing with non-cash charges. Now this is important. When you start with net income and you are computing your free cash flow to firm, one of the important adjustments you make is that you add non-cash charges. So this is one point. The other point is that you are doing and you are coming up with an estimate of free cash flow to firm generally with the intent of valuing a firm. And before I go further, let's just make sure we understand what we are doing. Let's say that you are coming up with an estimate of free cash flow to firm for the upcoming year, and then you will use the Gordon growth model to come up with the current value. So in this estimate, you want to use elements that are sustainable. So if you are dealing with items that are just one-off, they need to be adjusted out of your estimate because your valuation is going to be based on what will happen in the future. So if you are coming up with numbers based on what will happen in the future, then you need to adjust out any non-recurring or non-sustainable items. So for example, if you are adding depreciation, which is a classic non-cash charge, then the number that you are adding to come up with this estimate, you need to make sure that that's not an unusually high or unusually low number. You need to make sure it is a number that will continue in the future. That's one major point. Often the curriculum talks about restructuring charges. Why? Because generally restructuring charges do not recur. You might have some restructuring charges that are cash based or others that are non-cash based. So for example, if there is an asset write-down, which is a non-cash charge, does it make sense to add back a non-cash charge such as an asset write-down over here? Probably not, because this is not something that will keep happening in the future. So there is no fundamental right or wrong answer over here. The key point is you need to understand the nature of the non-cash charges and you need to figure out whether these will be sustainable or not. Another interesting point, which again connects with one of your favorite readings from level 1, income taxes, which is the following. You might have situations where a company has deferred taxes. In other words, the income tax expense is higher than the tax that was actually paid. You hopefully recall that that situation can happen. So here is a question for you. Clearly what is happening here is in your net income, for example, the income tax expense being deducted is higher than the actual cash that was paid. So if you are coming up with a cash-based measure, should you add back a number to make the adjustment? The answer is you should not, because that adjustment, the deferred tax or the deferred tax liability that is created is going to be reversed in the future. So if something is going to be reversed, then you should not be adding it. So fortunately, they do not drill you on this because the drilling has already happened at level 1, but conceptually just understand the fact that if something is going to reverse, then you don't make that non-cash adjustment. I'm not going to cover these examples here because I think that relative to the other examples, these are not as important, but if you have time, go over example 4. Key point being that if the working capital effect is sustainable, then you take it into account. If it is not sustainable, then you adjust it out. This is exhibit 6 from the curriculum, which talks about the classic non-cash charges and what sort of adjustment to make. And these are fairly self-evident. With depreciation, you obviously add back. This is where you are starting with net income and you are making adjustments to come up with FCFF. Amortization and impairment, that's added back, and the others are fairly self-evident. Alright, so we've talked about net income to FCFF, we've talked about CFO to FCFF. Now, what if you are starting with free cash flow to equity for some reason? How can you compute FCFE now from FCFF? So you've computed FCFF, how do you come up with FCFE? And hopefully, based on an understanding of these two cash flows, the formula will be fairly obvious. Your starting point is FCFF, then you subtract the interest expense, interest into 1 minus T. So what does this do? This says, okay, how much money is now left with equity holders? And then net borrowing. Net borrowing is the money available to equity holders. So free cash flow to equity is given by this term. Is it possible that the net borrowing is negative? It's possible this happens where debt is being paid back, or if debt is being taken in the sense that the equity holders are borrowing, then this will be plus. Okay, in the long run, the net borrowing hopefully will be 0. This is a simple illustration where we start with FCFF, we then subtract the after-tax interest, there is a net borrowing, and we come up with free cash flow to equity. Example 5 shows the working, and it is fairly straightforward, so I would like you to try it. I'm not going to cover it here explicitly. Next, FCFF and FCFE from EBIT or EBITDA. Okay, now all these are fairly logical, but I want you to not only understand the logic, ultimately I want you to also remember these, because if you are deriving them on the exam, then that just takes a lot of time. So obviously if you don't remember, then derive them, but better if you remember them. So this relationship should look familiar. We started out with this. Hopefully you recognize this relationship. Maybe you've not actually seen it in this form, but what's net income? It's EBIT. From EBIT, you subtract interest and taxes, and you will be left with net income. Okay, this can be rewritten. Basic algebra is being used over here as follows. So EBIT into, this is like multiply EBIT into 1 minus T, and then minus the interest into 1 minus T. So I was just explaining this algebra to my 6th grade child, and I'm sure you remember this. I hope you remember this. Okay, so then notice that if you take this relationship and plug into the numbers over here, what do you get? You then have FCFF is EBIT into 1 minus tax rate plus depreciation minus fixed capital investment and working capital investment. So what do we have over here? We can see that starting with EBIT, if you are already given EBIT, you can use this relationship to come up with FCFF. And then from here you can come here. What is EBIT? EBIT is EBITDA minus depreciation, and then you multiply by 1 minus tax rate, which is the same, plus depreciation minus fixed capital investment minus working capital investment. So all these are being derived through very simple algebra. This then can be rewritten as follows. And finally, once you have all these free cash flow measures, how can you come up with FCFE? You simply subtract the interest related payments and then add net borrowings. This is what we've seen before. This might seem rather boring, but I would say that this is one of the most important slides in this particular lecture, and you just need to go through it and learn these relationships. And here is an example of how these relationships will be used. You are given some basic information, and starting from EBIT, you need to come up with FCFF and FCFE, and then starting from EBITDA, you need to come up with these relationships. So I want you to pause the video and look at the exhibits in example 6 and solve this. Here is what you will come up with, and I'm just going to now highlight the critical points. As we just discussed, FCFF is EBIT into 1 minus tax rate plus depreciation and then minus the investments in fixed capital and working capital. You will notice that these numbers are fairly straightforward. The EBIT is going to be given, tax rate is given, the depreciation is easy, and in this particular example, the fixed capital number is also very easy to come up with. There will be some challenges associated with working capital, which I will talk about. And then the other challenge would be to figure out net borrowing. These are the two items that actually are the items that people get stuck with, so I'll make sure you understand them. All right, so I said one of the items was working capital, change in working capital. Let's take 2007. We've already touched briefly on calculating working capital or the change in working capital, which is that you take the working capital at the start of 2007. This is the net working capital, which would be the assets, the current assets minus current liabilities at the start of the period, end of the period, and then take the difference. But you cannot just take all your current assets and all your current liabilities. Two important things. You ignore cash, because we are looking at changes in cash which happens because of the non-cash assets and liabilities. So the cash numbers are not going to be considered in this calculation. The other important point is that under your current liabilities, you do not include the notes payable. The reason is that notes payable are a form of financing, and we are not going to take any item that is interest bearing or that is a form of financing. So the only item that we'll consider in our working capital is the accounts payable. This is from the short-term liability side. So those are the two critical points in coming up with the working capital investment. All right, on this particular slide, I've actually shown all the relevant data. If we compute FCFF now from EBITDA, so the EBITDA is given, 1 minus tax rate, the tax rate is given. This is the depreciation tax shield, which we saw earlier. So the depreciation is given, tax rate is given. Fixed capital investment, if you look at 2007 and you look at fixed assets, the fixed assets number went up by 400. That is where this 400 is coming from. It's a minus because the fixed capital went up, which means that the expenditure took place. And then minus 45, where did this come from? This is the increase in working capital that we calculated on the previous slide. And again, just to emphasize, with working capital, you are going to take accounts receivable, inventory, and on the liability side, you will take payables and you will take accrued expense. You do not use cash and you do not use notes payable. Then the other tricky item was related to net borrowing. Where do you need net borrowing? You need net borrowing to come up with FCFE. Remember, if you have FCFF, how do you come up with FCFE? It is FCFF minus this plus net borrowing. So what is the method that we use to come up with net borrowing? Because the notes payable increased by 50 million, and where is that? So notes payable went from 200 to 250, and long-term debt increased by 25 million. Where is that? So long-term debt went up from 865 to 890. So these are both forms of borrowing. How much was the total borrowing? 75 million. So what do you learn out of this? That to come up with your net borrowing, you look at both short-term and long-term borrowing. If those numbers are going up, that means the net borrowing is positive. If the numbers are going down, then the net borrowing will be negative. So these then, I would say, are the critical items out of example 7. Make sure you know how to come up with net borrowing, and make sure you know how to come up with the change in net working capital. Free cash flow to firm and FCFE on a uses of free cash flow basis. Hopefully you have realized this, but in all these earlier sections, we have calculated FCFF and FCFE from various income or cash flow starting points. Example, net income or cash flow. So we started with net income, or we started with CFO, and then we made adjustments to come up with FCFF and FCFE. This is the classic way of coming up with your FCFF and FCFE. An alternative perspective examines the uses of free cash flow. And can you think about what the uses of free cash flow might be? What happens with free cash flow to equity, for example? This is used to pay out dividends, or this could be used to repurchase shares. This could be used to maybe acquire other companies and so on. So you can evaluate the various uses and then add up those numbers to come up with an estimate of FCFE. But I'm not going to spend much time on this for two reasons. This particular section doesn't really have any examples, and it is not explicitly emphasized in the learning objectives. So if you really want, you can read through this section carefully, but I don't think it's overly important. Forecasting FCFF and FCFE. This is largely straightforward, just a few subtleties that might confuse you, and I'll cover those in detail. One way of forecasting FCFF or FCFE is a simple constant growth assumption. So you can come up with your FCFF over the upcoming year and then assume that this will grow at a constant rate of 5%. And where do you come up with this number? The simplest thing to do is to use some historical growth rate. Not some historical growth rate, but the historical growth rate of this particular company. And if you have reason to believe that this rate will continue, then you use it. Example 7, which is one of the simplest examples you'll ever find, which uses this method. Then here is something that is relatively new. Almost everything you've heard so far probably should look familiar. But another way of forecasting free cash flow is to forecast components separately. So you forecast sales growth, you forecast operating margins, and then based on that you can forecast operating profits. You also estimate fixed capital investment and working capital investment, generally as a percentage of sales. To come up with FCFE, you will also have to estimate net borrowing, and you do that based on your estimate of these investments plus your estimate of a debt ratio. A debt ratio means that for every 100 that you need, if your debt ratio is 40%, that means that for a planned investment of 100, your borrowing is going to be 40. So in all the examples that are based on this material, the debt ratio will be given to you. And the debt ratio essentially comes from the planned capital structure of the company. So in the examples that we'll work on, we'll make some key or some important assumptions. The first is that investments in fixed assets and working capital bear a constant relationship to increase in sales. So if the sales are increasing by 30%, then that increase in sales has a direct relationship with the investment in additional fixed capital or working capital. Also, unless we are told otherwise, we assume that the capital structure or the debt ratio remains constant. So let us look at this particular example now, example 8. And I want you to read this before I explain the content. This is material that you have not explicitly seen before. So let me walk you through this. So for this particular company, we are told that in 2007, the sales are 3,000 million and we are expecting a 10% increase. So the expected sales for 2008 are 3,300 million. We are also told that we expect the EBIT margin to be 16.67%. So that means that we can calculate EBIT for 2008 based on this number. Then we also know the tax rate, so we can multiply EBIT by 1 minus T. That is easy. But the two main items that you are learning through this example are, number one, how to deal with the investment in fixed capital and how to deal with the investment in working capital. Let's start with fixed capital. We've already said that the investment in fixed capital is tied to the increase in sales. We are also given this information. The amount for purchases of fixed assets was 400 million and the depreciation was 300 million. So the incremental expense on fixed capital is 100. And now you are looking at this as a percentage of sales. So note that sales went up by 300. So what we are saying is that if sales go up by 300, then our working capital is increasing by 100. In other words, this 33.33% is saying that for every dollar of additional sales, the investment in fixed capital is 0.33. Incremental working capital investment in the past year was 45, and this was given earlier. And that is saying then that for every dollar increase in sales, the amount of incremental money spent on working capital is 0.15. So putting all this together, for 2008 then we are saying that if sales go up to 3,300, EBIT is 16.67%, which is given. EBIT into 1 minus tax rate is 330, again based on the tax rate. And then incremental fixed capital is 100. Why 100? Because it is going to be 33.33% of the increase in sales. And working capital, you subtract 45, 15% of increase in sales. So this is your free cash flow. And if you make an assumption that these ratios and numbers will continue in the future, then based on the sales projection, you can then also project your free cash flow. Or if you assume that this company will have tighter margins, if you believe that the EBIT margin will shrink, then you can make that assumption. If you believe that these ratios are going to change, then you can make those assumptions. But generally, we assume in most of the examples here that the ratio to sales of fixed capital investment and working capital investment generally stays the same. Okay, example 9 is related. This connects with what I was just saying. Our analyst now believes that the margins will come down and we don't need to work through all these numbers, but notice here that EBIT margins are coming down, but what's happening to incremental fixed capital investments? They are still staying at 33% and 15% of the sales growth. So you can then come up with your free cash flow to firm estimates. Okay, example 10 covers another important point which has to do with figuring out your net borrowing. And I want you to pay close attention because this is not something you've seen before. So now our analyst wants to evaluate FCFE. And to come up with FCFE, if you are starting out with FCFF, you also need to figure out what the net borrowing amount must be. If we assume a 50% debt ratio, what does this mean? This means that for every $100 of additional investment, how much will we have to borrow? The debt or the borrowing will have to be 50. So we need to come up with our investment amount. And what is that investment amount? We have already established that the investment in fixed capital is 100. The investment in working capital is 45. So what is the total investment required? 145. So what is the net borrowing? 72.50. Where is this coming from? This is simply 50% of our total investment. And then where is this FCFE number coming from? So what we are doing is we are starting with 264 and then deducting the incremental fixed capital investment, deducting the working capital investment, adding the net borrowing, and that gives us 191.50. Okay, coming to the last segment of section 3, other issues in free cash flow analysis. Analysts should adjust the reported CFO number by removing the impact of financing or investing activities. The curriculum refers to these as contaminations. You are starting out with a CFO number which has been created based on US GAAP or IFRS, so that is the reported number. But if you are coming up with a CFO in order to do valuation, then you need to remove any impact of financing or investing that might have crept into the reported number. So remove those contaminations and then you have a clean CFO number. Use that as a basis for your valuation. Here is a point that we've talked about before, but it needs to be emphasized. Many analysts prefer FCFF valuation models over dividend discount models for these reasons. Several companies pay little or no dividends. With some companies, dividend payments are at the discretion. In fact, in general, dividend payments are at the discretion of the corporation's board of directors and might not be indicative of the company's long-term profitability. So a company might be very profitable but might be paying very little dividends. FCFE is the cash flow available to shareholders without impairing company's value. What does this mean? When we come up with FCFE, we are subtracting the necessary investments in working capital and fixed capital. So this number that we come up with is based on the assumption that the company will keep investing in assets and projects that it should be investing in. Now, in all the formulas that we've talked about so far, dividends and share repurchases and so on are not visible at all. Why is that? The reason is that if you take FCFE, the dividends and share repurchases are happening from the FCFE. So these activities happen after you come up with FCFE, or you can think of this is the pool of money. Then money can be given out to shareholders as dividends or as share repurchases. So these happen afterwards. That's why in calculating the FCFE, we do not add or subtract any of the transactions with shareholders. So there is a question about issuance. The point with issuance is that issuance is a financing activity. So this is where shareholders are putting more money into the company. Whereas when we talk about FCFE, we are talking about the money that is being generated by the company, which is available for equity holders or shareholders. Continuing with measures of cash flow, FCFF and FCFE, as defined in this reading, are measures of cash flow designed for valuation of the firm or its equity. Other definitions of free cash flow frequently appear in textbooks, articles, and vendor-supplied databases of financial information or public companies. This text, by the way, is straight from the curriculum. Because using free cash flow analysis requires considerable care and understanding, some practitioners erroneously use earnings components such as net income, EBIT, EBITDA, or CFO in a discounted cash flow valuation. Such mistakes may lead the practitioner to systematically overstate or understate value. Before I go on to this next point, which is fairly testable, I just want to emphasize this exact point. I have seen students come to me who complain that the definition of free cash flow in another textbook is different. And that exactly is the point being made over here, that in different places you will find different definitions. And you as an analyst need to understand the definition and understand the context behind that definition. The context here is that if you are valuing a company, then the definitions used here are most appropriate. And whether or not you agree with it, if you are taking the CFA exam, then just agree with the fact that these definitions are most appropriate from a valuation perspective. One of the most commonly used proxies or shortcuts for free cash flow is EBITDA. And perhaps the reason for this happening is that you can quickly look at an income statement of a company and extract EBITDA. You don't need to do all these complicated calculations related to working capital investment, fixed capital investment, net borrowing, and so on. So an exam question might involve figuring out what are the limitations of EBITDA as a proxy of free cash flow. And the quick way of coming up with the issues is by simply looking at this formula. This formula shows the relationship between FCFF and EBITDA. So if you are saying that EBITDA is a proxy or an approximation of FCFF, what are the areas that you are missing? So note that EBITDA does not subtract taxes. When you think of FCFF, is that money before taxes or after taxes? It's after taxes, because the shareholders and the bondholders get money after taxes. So EBITDA does not subtract taxes. That's one issue. The other issue is that EBITDA does not tell you about this depreciation tax shield. Do shareholders and bondholders, so does the firm benefit because of the depreciation tax shield? Yes. That is not accounted for in the EBITDA measure, it is accounted for in FCFF. Fixed capital investments, does that reduce the cash available to the suppliers of capital? Yes, not accounted for in EBITDA. Working capital investment, also not accounted for in EBITDA. So just looking at this, issue number 1, taxes; issue number 2, depreciation tax shield; issue number 3, fixed capital investment not accounted for; and issue number 4, working capital investment not accounted for. So you need to reel these out based on the formula. So here is a classic example that I can easily see showing up on the exam, or something like this. A recent job applicant made some interesting comments about FCFE and FCFF. So this is what he said. I don't like the definitions of FCFE and FCFF because they are unnecessarily complicated and confusing. And I can see some people saying that. The best measure of FCFE, the funds available to pay dividends, is simply net income. You take the net income number straight from the income statement and don't need to make any further adjustments. So remember, this is the interviewee saying all this. Similarly, the best measure of FCFF, the funds available to the company's suppliers of capital, is EBITDA. You can take EBITDA straight from the income statement and you don't need to consider using anything else. How would you respond to the job applicant's definition of FCFE and FCFF? Personally, what I do is ask him to leave and sign up for the CFA program. But obviously that's not what this question is looking for. So what do we do? It's fairly straightforward. So what did he say about net income? So instead of FCFE, he's saying that just take net income. So to look at the problem with that statement, you go to this formula which shows the link between FCFE and net income. So if you do net income, you are ignoring non-cash charges, you are ignoring the investments in fixed capital and working capital, and you are ignoring net borrowing. If you use EBITDA as a proxy for FCFF, then we've already talked about the limitations of that measure. All right. So we are getting to the end of this segment. How do you deal with preferred stock? Everything that we've talked about so far basically says debt and equity. But what if you have a somewhat complex capital structure that involves preferred stock? That is illustrated in example 13. Now you can go through this, but what I'll do is just highlight the fundamental point. In this particular example, you are first asked to calculate WACC, which is extremely straightforward. You've seen this at level 1 in cost of capital and then again at level 2. So you can take the weighted average cost of capital based on the information provided. Then this is actually the part that is important. If the company did not issue preferred stock, then FCFF would be essentially the relationship that we've been talking about. If preferred stock had been paid and net income is income available to common shareholders, which is what has been defined over here, The preferred dividends must be added back just as the after-tax interest expenses are. Does this make sense? That just like you add back after-tax interest expense because you are identifying the money available also to debt holders, now you need to add back preferred dividend because the preferred shareholders are also suppliers of capital. But will that be on an after-tax basis or not? In the case of preferred dividend, there is no tax reduction. So all you do is add back the preferred dividend also. In this particular example, the preferred dividends are 8. So in our expression, we are adding back 8. So that is the major item being emphasized in this example. Other than that, the material is similar to what we've seen in other places. So you can go through the solution. You come up with FCFF at the end of period 1 and then use Gordon growth to come up with the value of the firm. Then you come up with the value of the equity by taking firm value and subtracting the market value of debt and the market value of preferred shares. Free cash flow model variations. And here we have an international application of the single stage model. Then we talk about sensitivity analysis. Fortunately for us, a lot of what we'll see here is an overlap with what we've seen before. And this is a larger point with equity, that there is a substantial amount of overlap. So I think that you really need to do well on this particular topic. Okay, so international application of a single stage model. Now, when this particular reading talks about international, it is actually specifically talking about countries where there is relatively high inflation. So if I were naming this section, I would really refer to it as emerging markets. When you are investing in stocks in high inflation countries, then typically you will use real cash flows and then real interest rates to discount numbers. Okay, because with inflation, if the numbers are high, they might be hard to predict in nominal terms. So you bring everything to real terms. And as we've seen in corporate finance, if you are projecting your cash flow in real terms, then you should also discount using a real rate as opposed to a nominal rate. So how do you come up with a real discount rate? There are different ways of doing this, but the method that is given in this particular reading is essentially a build-up model, which we studied in an earlier reading. So let's say you are trying to come up with the appropriate discount rate for company X, which is in an emerging market country with relatively high inflation. The first thing you do is use the real rate that is perhaps the average rate for that particular country, so the country real rate, and then you make a few adjustments. One adjustment is related to the industry, and these numbers might be plus or minus. We don't need to get too hung up with this because, as you will see in an example which will follow on the next slide, the numbers will be given to you. All you really need to know is that there'll be adjustments. There'll be a size-related adjustment, leverage-related adjustment, and then you will come up with the required real rate to use. Then you simply use your Gordon growth model, where you take the real growth and discount using R minus G, all real numbers. Okay, so here is a very straightforward example. It might look complicated, but the underlying concept is straightforward. You are given the various adjustments in this discussion over here. This is the country real rate, and then these various adjustments are given, and you come up with the required rate. Then your value is FCFE into 1 plus G, so that's this over R minus G, and you come up with a number. So nothing too complicated. Next is sensitivity analysis of FCFF and FCFE valuations, and this is something you've also seen before. To examine how sensitive the final valuation is to changes in each of the valuation model's input variables, analysts can perform a sensitivity analysis. some input variables have a much larger impact on stock valuation than others, and this is illustrated in example 14, which demonstrates that with each variable, when you use a base case, low level estimate, high estimate, between the low and high, you will get different valuations. And you can look at the numbers to see that even small changes in the growth rate can have quite a substantial impact on the value that you calculate. And again, this should be nothing new. We've seen this before. Continuing with material that we've seen before, two-stage free cash flow models. We talked about this in the context of dividend discount models. Now, instead of taking dividends, we take free cash flows, and then after that the concept is the same. So this formula is one that you should be quite familiar with by now. What do you do in a two-stage model? You basically say that in stage one you have a relatively high growth rate, and if you don't know the precise growth rate, you might actually say that initially growing at 20%, then 15%, but for a certain period, you take all the free cash flows based on whatever growth rate, and then after a given point, you then either assume a sustainable constant growth rate, or what you might do is just take a terminal value and a multiple and come up with, basically take a multiple, come up with the terminal value and discount back, exactly like what we have seen before. A very simple scenario is given in example 15, where we are told that for 3 years the growth rate is 20% and then it is 6% forever. And the assumption here is that we can then compute the free cash flow per share, and you discount back each of these cash flows, and then for all these other cash flows you assume the Gordon growth model and discount back. Since you've done this before, I'm not going to repeat the calculation. Two-stage FCFE valuation model with declining net income growth in stage one. So this is also possible, that you have a high growth rate, very high growth rate, which is declining, and then eventually it stabilizes. Now, I actually included this excerpt because I wanted to connect this with what we have seen before. You can read all the text given in the example, but notice these numbers. We are given fixed capital investment per share. These numbers are actually given as part of the question. And then also the working capital is given as part of the question. You are told, in fact, that the working capital investment every period is half of the fixed capital investment. The fixed capital numbers are given, and then the working capital, you are told, is half of fixed capital. So the slightly tricky item here is to compute the debt financing. So what is the net borrowing every period? And how do we do this? To come up with net borrowing, we need a debt ratio, and we are given that the debt ratio is 30%. This is also given in the question. So if the debt ratio is 30%, then what's your net borrowing on a per share basis? So in any particular year, you add up the fixed capital investment and the working capital investment and take 30% of that, and the 30% number essentially will be the debt financing. So the rest of this is fairly self-evident. If you have FCFF numbers, you can then use the debt financing or the net borrowing to come up with FCFE. Example 17 talks about two-stage FCFE valuation with declining sales growth rates. All these are fairly straightforward, just different ways of doing essentially the same thing. If you have time, you can go through that example. And then three-stage growth models. This should also look very familiar. Three-stage models are a straightforward extension of the two-stage models. One common version of a three-stage model is to assume a constant growth rate in each of the three stages. You've seen this before. The growth rates could be for sales, profits, and investments in fixed and working capital. External financing could be a function of the level of sales or changes in sales. We've seen this before. And the simplest form of this model would be where we directly assume the growth rate to be associated with FCFF or FCFE. I hope you see the point here. One complicated way of doing this is to assume that the sales will grow at a certain rate and then use ratios and so on to come up with the bottom line impact on FCFE. A simplistic approach is to directly assume that FCFE or FCFF will grow at a certain rate. A second common model is a three-stage model with constant growth rates in stages 1 and 3 and a declining growth rate in stage 2. Now, in this particular reading, the relevant examples actually give you the exact declining growth rates. So if you look at the growth rate over time formula, you have a constant rate and then you are given some declining growth rates and then a constant rate again for the third stage. This reading doesn't explicitly talk about the H model, but can you imagine an exam question where you have to apply the H model with FCFF? It can easily show up because the calculation is exactly the same. You could have a scenario like this where instead of talking about dividends, we are talking about free cash flow to firm. So you would use the H model to come up with the valuation at this point and use the exact same logic that we did earlier with the DDM related numbers. All right, this is another straightforward example which is based on three-stage FCFF, and I'm not going to run through this because it is quite easy. All this material you have seen before. Just at a high level, what we are doing is we are given the growth rates, and as I just mentioned, in this three-stage model we have a constant rate of 8.8% initially, and then we decline, and then there is again a steady growth rate after a given period. And essentially we are discounting the FCFFs back. There is a terminal value at the end of year 7 based on all these numbers, and that terminal value is based on Gordon growth model. You get the terminal value discounted back and add the present value of all the other cash flows. Hopefully this is extremely simple. If it is not, then I would be somewhat concerned. All right, so that's the answer you would come up with.
Environmental, social, and governance factors can have a significant impact on valuation. Keep in mind that ESG factors can be quantitative or qualitative. Quantitative factors are relatively easy to deal with. So for example, if you can project a certain amount of environmental fine, then that can be reflected in the cash flow projections. Qualitative factors are those factors that an analyst considers material or important but are difficult to quantify. And one way of dealing with qualitative factors is to add a premium to the cost of equity. I'd strongly encourage you to read the example in the curriculum which outlines how to integrate ESG factors in a three-stage FCFF model.
Okay, the final section of this reading, which is a very short section, non-operating assets and firm value. This actually is important because I find several students who get confused by what is stated over here. It is a fairly basic concept though. Let me read what the curriculum says and then I will explain it. Free cash flow valuation focuses on the value of assets that generate or are needed to generate operating cash flows. If a company has significant non-operating assets such as excess cash, excess marketable securities, or land held for investment, then analysts often calculate the value of the firm as the value of its operating assets plus the value of its non-operating assets. In other words, the value of the overall firm is equal to the value of the operating assets plus value of non-operating assets. So what does this mean? When a company has property, plant, equipment and so on, and cash flow is being generated, who has a claim against that property, plant, and equipment and the cash flow that is resulting? It is all suppliers of capital. So if this is the set of operating assets and cash flow is being generated, then when we come up with the present value of the cash flow, that essentially is the value of our operating assets. Now, if in addition to these operating assets, let's say that this present value is 100 million. In addition, a company has 20 million in marketable securities that have nothing to do with the operations. Doesn't this 20 million also add to the value of the firm? It does, because it is in the firm's bank account, let's say. Therefore, the total value of the firm in this scenario is 120 million. Now, let's also say that the market value of debt is 30 million. Then what is the value of equity? The value of equity would then be the total value of the firm minus the market value of debt, which is 90 million. And this connects with one of the first points I made in this lecture, where I said that I'm just brushing over the point for now, because throughout most of this reading, we have assumed that the value of non-operating assets is essentially zero. For most companies, the non-operating assets would be a very small percentage of operating assets. So very often this number is ignored. Another source of confusion is that in some of the formulas in this reading, you will see that value of firm is equal to the present value of all the free cash flow to firm. And here we see value of firm is this plus this. Why is that? When we say value of firm is present value of free cash flow, essentially we are then assuming that this is close to zero. So I know I'm repeating here, but if that assumption is not true, then you need to add the value of non-operating assets to come up with the overall value of the firm. All right, let us now summarize the main points. Free cash flow models relative to dividend discount models. One of the most basic points here is that you need to understand when to use the free cash flow model relative to the DDM. You can use the DDM when a company pays dividends and dividends have a clear relationship with the profitability of the firm. If not, then you should not use the DDM, then you use free cash flow models. The next question then becomes when to use FCFF versus FCFE. If a company is highly leveraged and there are situations where FCFE are negative, then it makes sense to use FCFF. Another situation is where the capital structure is fairly dynamic. There again, it makes sense to use FCFF. What is the link between the value of a firm and value of equity? So you can come up with the value of the firm by taking all the free cash flow to firm. So all those free cash flows and discount back using WACC. That will give you the value of the firm. Again, assuming that the non-operating assets are negligible. And then from the value of the firm, how do you come up with the value of equity? You simply subtract the market value of debt. If you are discounting FCFE, then the discount rate you use is the cost of equity, and the present value that you will get will be the value of equity alone. Here I have actually listed all the FCFF formulas that we have talked about in this reading, and I am listing them here because I think it is extremely important for you to learn these, and you need to do that. Either you learn them or you learn how to derive them very quickly on the exam, because you are bound to see this. 2-stage and 3-stage models, I'll not talk much about them over here, because this is material that you've been seeing over and over. So once you have a pattern for your free cash flows, then based on that pattern, you can come up with the present value. You might have
The most simple scenario is a one stage where you use Gordon growth. In a two stage, you will make a certain free cash flow for a few years where you discount back individually, and after that you assume either Gordon growth or you use a multiple to come up with the terminal value. And then you can also have three stage models, you can have the H model, and so on.
That is it for this reading.